This is brought to you by John Daniel and Partners LLP.
Good morning once more. Welcome to today's webinar. My name is Frida Mbabu. I work at John Daniel and Partners LLP. We are a CPA firm based in Nairobi, Kilimani. Our topic for today is on tax trends and tax planning for SMEs. I know it's a very controversial topic right now, given the current trends in the country and what has been happening in the recent weeks. But I invite you to join us as we try to dissect on what has been happening and what's the way forward for SMEs. Our speaker for today is John Zombe, is our accountant here in the firm. He will be guiding us in today's webinar. Welcome. John, if you can hear me, please. And before we begin the webinar, I'd like to encourage us to use the chat box. If you have any question that you need addressed, you can use the chat section area. And please, when the speaker is talking, remember to switch off your mic. Thank you.
Thank you, Frida. Good morning. I hope I'm audible first.
Yes.
So I think I'm just going to switch on my video for a moment, just to say hi. I'm John Dombe, as Frida has introduced me, and I'm the one who is going to take us through today's topic. We are going to look at the tax trends. And with the recent developments, we want to know maybe where we stand as businesses, and also the way forward, so that we can remain ahead of the curve in terms of taxes and compliance. And also we will be looking at how we can do tax planning to ensure that at least we minimize the tax expense legally, while we take advantage of the available incentives, deductions, exemptions that are available as provided in the law. So I welcome you all, and I hope we will learn a thing or two so that we can be able to sustain our businesses even in this changing tax landscape. So I'm going to switch my video off for purposes of signal strength. As I present, if you have any comment or question, you can post it in the comment section so that my colleagues and myself, we can address those questions. Thank you. So Frida, I wanted to confirm if my screen is visible.
Yes, please.
Thank you. So today we'll cover a few items, and we'll cover the overview of taxation regime in Kenya, and we understand we are in a situation whereby we are supposed to have a finance bill and a finance act before June 30th to guide us on how we are going to raise revenue for the 2024-2025 financial year. We understand that the president withdrew the 2024-2025 bill yesterday. He declined to sign it to become law, and there are various alternatives that can happen to put us on the path of maybe some changes or to retain the status quo of the Finance Act as it is, 2020, the one that is currently in use, 2022-2023. Be that as it may, there are some suggestions that came up during that finance bill that is contested, which may or may not go away, even as maybe the bill is taken back to Parliament, maybe for further considerations, maybe for deletion of some clauses, maybe for a fresh bill. So we thought maybe it's necessary, even as we get into that conversation. I know it's an ongoing conversation even today. People are still expressing their opinions, but we know it's important to be in the know on how maybe the bill is prepared and the areas that it affects, so that we are better prepared. So we are going to handle income tax, the proposed changes, the targeted areas, VAT, excise duty, and also we are going to look at the possible changes in the Tax Procedures Act. And finally, we are going to look at how we can better plan in the area of tax as businesses. So by checking on the taxation landscape and just an overview of how it is done in Kenya, we realize that the business environment as we speak today is characterized by a very fast growing, fast evolving and changing fiscal policy environment, because the government is keen to steer the country into some form of economic recovery. We understand that as a country, we have not been performing quite well in some sectors. So the government is keen to improve on those sectors and at the same time increase the revenues. So that balancing act characterizes the current business environment. It is very evolving. And by checking the BPS, the budget policy statement, which informs the areas where the government is planning to raise revenue from and the areas where the government intends to spend the money collected on, we get the statistics that the government targeted. This BPS is normally prepared around between February and around April. So that one guides how the budget will be prepared, and also how the finance bill, the one that is contested right now, the areas it will cover, the areas it will target. So the one that was prepared this year, in March this year, the government was targeting to collect around 2.95 trillion in taxes. And this was up. This was an increase from the one that was projected in 2023, 2024, which was around 2.62 trillion. And this is majorly the ordinary revenue. So you see that increase of around 200 billion. I think that is what the president was talking about yesterday. The difference of 200 billion between what was projected in 2023-24 and now 24-25 is what they were looking to fill that difference with the various proposals that were contained in the contested finance bill. And the major target, or the major areas that were targeted through this bill, was the areas that are considered hard to tax, mostly the informal sectors, the agricultural sector, and also the digital platforms, the activities that are done on the digital platform. And as such, since we understand that most businesses they operate in these areas, the small businesses, the medium sized businesses, mostly they operate in these sectors: the agricultural sector, the digital services sector, the informal sector. So it is important now for these businesses and individuals who operate in these in those sectors to closely monitor these developments so that they are well prepared to align with these changes. Beginning with the income tax. Income tax mostly is a direct tax, and KRA or the tax authorities they find it easier to raise revenue from it. So some of the proposals that were made during the contested finance bill, one was to exempt businesses that have a turnover, the gross turnover of less than 1 million yearly. We know currently the status is everybody, as long as you are doing business in Kenya, you're supposed to have onboarded on e-teams. But the proposal was to at least exclude the small businesses who have a turnover of less than 1 million, which was good, by the way, because these small businesses were finding it hard to navigate the intricacies of e-teams, having to generate the invoices. To them, it looked cumbersome. So it was a relief to them. And also another proposal was to increase the non-compliance penalty from 1 million to 2 million. Currently, it is 1 million. If you don't comply, that is the penalty. And now, if now we are going to retain the status quo, if we are going to work with the Finance Act as it is for 2023-2024, then the e-teams issue, these proposals, of course, now will not be implemented. We retain the ones that the measures that are already in, that everybody should onboard e-teams. The other proposal was to increase the allowable mortgage interest. Currently is 300,000 per year. That is around 25,000 every month. But the proposal was to increase it to 360 per year. That is 30,000 per month. And this majorly was to incentivize people to save more towards home ownership, because now this would reduce their financial burden in terms of the taxes they are supposed to pay. So more people would want now to take advantage of this to contribute or to take mortgage loans to buy homes, which I think is part of the government's agenda on affordable housing. The other proposal was to remove the limit for the withholding tax on management and professional fees received after rendering services. Currently, for management and professional services, the cap is at 24,000. So if you earn below 24,000 from a consultancy, that one is not subjected to withholding tax. But this was proposed to be removed, so that even if you earn 1,000 bob, that would be subjected to withholding tax of 5%. The other bit that these changes focused on was on the digital service tax. The digital service tax is what is operational right now, but they proposed to replace it with another type of tax. We are calling it significant economic presence tax, which was now to be charged at the rate of 30% of the 20% of gross profits that an organization or a company made. That is, out of the gross profit they made, 20% of that gross profit was to be charged 30% tax. And that now would be remitted before 20th day of the following month after now the payment or the service was after the service has been rendered, just the way we do VAT. And this would have a significant implication because now, especially the non-resident service providers, this will increase their cost because I believe there is also an excise duty already charged to these services. So this would increase the tax burden to them. Although that was just a proposal, we don't know if maybe it is going to be retained in the considerations that they will be made, but that remains to be seen if it will be considered. The other one was to increase the pension allowable deduction. So the bill was proposing to increase the allowable pension contribution by an individual, and it must be a registered. It must be made to a registered pension fund. Currently, it is 20,000 per month, but the proposal was to increase it to 30% per month. And this was just like we have seen in the mortgage interest increase. This was now to incentivize more savings towards retirement. The motive here was to ensure that at least people are encouraged to save for their latter days, for the times, for the days, for the years that they will not be working. The other bit was exemption on withdrawals, or a tax exemption on the withdrawals from pension, provident, and individual pension funds. The bill sought, or the proposed changes sought to exempt tax on withdrawal of the pension, provident, and individual pension funds after attainment of the retirement age. So this one was at least meant to ensure at least if people are compliant of the terms or the rules of the fund, they are able to take advantage of this exemption. So if for example they don't withdraw the pension or the provident fund before the time that is allowed, that is, if they withdraw after the time has reached the time the rules dictate, they are able to take advantage of this exemption, and they will be easy. They will have some easy access to their retirement benefits. The other proposal was on the withholding tax to supply of goods to public entities. So currently it's not the case, but this proposal, just like we started by seeing the government measures to raise more revenues to fill in the gap, they wanted now to impose a 3% withholding tax to residents and 5% withholding tax to non-residents when they supply goods to public entities. Of course, this would increase their tax burden because this has not been happening currently. So the other bit was, which was a good move, was to include affordable housing levy. The SHIF is the one that is going to replace NHIF. So affordable housing levy, SHIF, and the post-retirement medical contributions, they were proposed to be deductible before before arriving at the overall taxable income. And this would mean that now the taxable income, or the tax that now will be charged to your income, would be marginally reduced after deducting these ones before you charge tax on the remainder. So this was a good move. I'm hoping it will be retained, especially for the employed people who have suffered maybe some additional deductions from their payslips. Maybe this is a welcome move if it will be retained. The other bit was on the per diems. Per diem currently is capped at 2,000. So if you get something above 2,000, it will be chargeable to tax. But the proposal was to remove the cap, but instead have a percentage of the employee's gross salary. So we are now in the space of waiting to see if such a proposal maybe will be considered in the subsequent finance bill for it to get into the implementation phase. The other bit was the withholding on interest that is received or interest that is earned from infrastructure and social bonds. Currently, they are exempt, but the bill proposed to impose a withholding tax of 5% to residents and 15% to non-residents. And this, of course, incentivizes residents to invest in such securities. But for non-residents, it becomes very unattractable to them because the higher tax, of course, will mean a burden to them. So I think this is just another measure, just like we have seen in the other slides, to increase the revenues or to tax the areas that previously have not been chargeable to tax. The other bit is on penalty on underpayment of installment tax. Currently, it is at 20%, but the proposal was to reduce that to 5% of the tax arrears or on the unpaid tax, which was I think this was a good move. The other bit was withholding tax on digital market platforms. So income deemed to have accrued in or derived from a digital marketplace made to a resident and non-resident persons. It was proposed to be subjected to withholding tax, 5% for a resident and 20% for non-resident. And the motive here, or the objective here, was to bring more players in the digital economy, in the tax net. You realize that most of the businesses, they have moved online. So we see a lot of activity online, whether it is advertising, influencers, doing some marketing for companies. So those activities that they appear to be increasing. The government is not blind to the fact that now businesses are moving from maybe the brick and mortar and they are moving online. So that's why they are keen to increase or to have them in the tax net. The other bit was on non-cash benefits that employees receive. And these include, for example, the meals, the non-cash benefits that employees receive besides their salaries. So the aim here was to increase them from 36,000 to 48,000, which I think was a good move, because previously it was capped at 36. You could only deduct to a maximum of 36,000 as an expense. But now the proposal was to increase it to 48,000, which was a good move, because that now reduces your tax burden. The other bit now is on VAT. VAT currently, for businesses that have annual turnover below 5 million, they are not supposed to register for VAT. The cap is at 5, or the threshold is 5 million currently. But the proposal was to increase the threshold to 8 million, which was good. It was a good relief to especially the small businesses, because now this means that they won't be required to register for VAT until the time they reach 8 million as turnover for the year. So this majorly was to ensure that at least inflation was taken care of, and also, as I have said, to decrease or to reduce the tax burden to the small businesses. The other bit was the transfer of business as a going concern. Normally, transferring a business as a going concern attracts VAT. So the proposal was to scrap the VAT requirement or our addition to the sum that are accrued, to the sums that are received when transferring a going concern, a business which is a going concern. So this was aimed at facilitating a smoother business transfers. And I think this was a welcome move. If this can be retained, I think many businesses will welcome this. So more to VAT was on scrapping the 24-month limit for lodging a VAT refunds on excess input tax. So this removal of the requirement for VAT refund application was to be applied within 24 months from the date the tax became due and payable. This has not been the case, so I think this was a good move to align this with the other claims, so that now the companies, organizations, or individuals who are registered for VAT, they are not time barred to claim their VAT refunds. Then we had another proposal to exempt insurance and reinsurance premiums from VAT, which was also another good move. And this was also to encourage and to at least put in some support in the insurance industry, so that the uptake of insurance is well enhanced. So we are keen to see if this will be retained in the subsequent proposals. The other area is on the excise duty. We understand that excise duty is majorly targeted on the areas of practices that the government would want to rein on, to control, like betting, gaming, sometimes even the alcoholic beverages, financial, sometimes on the financial transactions, such like areas. So the proposal here was to increase excise duty on betting, gaming, and lottery winnings from the current rate of 12.5% to 20%. And of course, the implication here would be the cost to bet or the cost to run a betting business will be substantially increased. So maybe it's a measure to disincentivize people from betting or from engaging into gaming and betting activities. For alcoholic beverages, what has been happening is the excise duty mostly has been tied to the volumes. But now the proposal was to tie the excise duty on the content, the alcohol content. So if the alcohol content is high, maybe above a certain standard, the rates now would change. The rates now would be different. They would be graduated depending on the alcohol content in those alcoholic beverages. The other bit also on excise duty was to charge the duty on motorcycles with a rate of 10% of the value, or Kenya shillings 12,902.83 per unit, whichever is higher. Of course, this would mean a tax burden to the owners of these motorcycles. And we understand that there are companies, there are organizations that have these assets. Maybe you have a motorcycle for deliveries. Now this would affect you negatively because it would increase the tax that you will pay. Then the other bit was imposition of excise duty on non-resident digital service providers. Besides the VAT proposal that you have seen in another slide on these non-resident digital service providers, the bill was proposing also to impose excise duty on these services that are offered by the non-residents through digital service platforms. The other bit was advertisements on the internet and social media, especially on the alcoholic beverages, betting, gaming, lotteries, prize competitions. All these activities, which are also in the tax, they are also within the tax net. But the proposals were to subject them further to excise duty at a rate of 15%. The other proposal was on the procedures, the tax procedure, and one was to remove weekends and public holidays when you are calculating the days for you to submit the returns and pay the payments or to make the payments. We understand currently, if, for example, you are filing for VAT, if you're filing for VAT, you should file it by 20th of the following month. And that includes even the weekends. If there are public holidays in between, you don't exclude them. But the proposal was to exclude such days. And this, I think it would bring some confusion, especially because it won't be standard every month. So if organizations or accountants or people who file these returns, they are not keen on such happenings. For example, the public holidays, the weekends, if they don't do the calculations well, they may miss out the deadline. Contrary to what it is currently, because you are sure by 20th, if it is VAT, you should have filed. If it is on the statutory deductions, the pay and the rest, on date 9, you are sure the law requires you to have filed and remitted the returns. But now, including now weekends and public holidays, exemptions, when you are counting, it would mean that now people will have to be very keen on even updating themselves. You have to remember how many public holidays have we had. Yeah, such like terms. The other bit is on the extension of timelines for issuing objection decision. Sorry. Currently, it is 60 days, but the bill was proposing that to be increased to 90 days. And I think this was a good move so that KRA could have ample time to consider its decisions. The other bit still on tax procedure was to offset overpaid taxes against existing liabilities. So tax funds resulting from overpaid tax were to be made within 5 years for income tax and 6 months for all other taxes. So that was the proposal, but currently only application for refunds relating to VAT are limited to 6 months, while all the other tax refunds, they are sought within 5 years. This was just to align, just to make an alignment. The other bit was on automatic confirmation of assessments due to failure to provide documents, mostly during assessments. So where the KRA requests maybe an organization or a business to provide additional information during an objection stage, if the taxpayer would fail to provide that information, so that objection was supposed to automatically be disallowed. That was the proposal. So if you don't provide those documents or that information that the tax authority is requesting from you during that objection stage, it means that if you don't provide now, that shall automatically be disallowed. So I think we have covered most of the areas that were to be affected and maybe will still be affected, even as the finance bill is back into the parliament, maybe for further reconsiderations, or maybe for the deletion of the clauses, maybe for a fresh finance bill to be to be crafted and be put together. Maybe those are the areas that we'll be keen to see if they will be still retained or there are any changes that will be fronted on those areas. The second bit here on this webinar was on tax planning. So having discussed all those obligations that may fall on the businesses, we need as businesses now to plan. How are we going to make sure that at least we are ahead of the curve in terms of the tax obligation? So tax planning here would define it as the organizations or a business set of measures to minimize their tax liability. The measures you put in place legally to make sure that at least you have minimized your tax liability. And this one is it is broad. It entails different measures, like we shall see. For example, taking advantage of exemptions. Maybe in the area you are operating in, there are some exemptions you can take advantage of. Some exclusions, deductions, permissible allowances, and even rebates. Like, for example, we have seen in the proposals, the government was encouraging people to save more into retirement benefit schemes, also to take up mortgage so that the interest from mortgage is now an allowable deductions. Such things can be taken advantage of by businesses, by individuals, to at least reduce the tax liability. So tax planning requires a deep understanding of the tax laws, the tax legislation as a whole, so that now you are able to know what the law says, and now you are able to make some good plans, but still in compliance with those laws, for you to be able to minimize your tax liability. So why tax planning? Why are we discussing tax planning at this moment? We understand that tax is a very critical expense for a business. So we need to think about it and plan for it, because there is need to minimize, for example, tax penalties and interests, which mostly are associated with non-compliance. For example, there is what we call installment tax, whereby the government expects you as a business to pay tax in advance. For example, in 2024, instead of you waiting up to January 2025 to pay taxes for this year, the government requires your business to be paying taxes for this year in installments. The normal business is supposed to have 4 installments. And how you do this, you project using the previous year's net income. So you add a margin of 10%. Suppose maybe in 2023, you made a profit of 100 shillings. So you project that in 2024, you'll make a net income of around 110 Kenya shillings, so that now you can plan and pay taxes that would ideally be chargeable to that income. You divide it into for example, the normal businesses, you divide it into 4 quarters, and you pay it in installment, so that at the end of the year, if maybe you have overpaid, you get credit, which you can use to offset future tax obligations. Or if you have paid less, now you can top up and pay now before the first quarter of the following financial year. So most businesses fail to observe this, and they end up being penalized. And now, even after being penalized, the amounts they have not remitted, it is subjected to interest. So it's good to be aware of that requirement, so that we avoid those penalties. The other bit is on timely filing and remittance of statutory deductions. The normal statutory deductions, the payee, the NSSF, the NHIF, all those deductions, they have their timelines for filing and also for payment, for remitting the deductions. So organizations or businesses ought to be keen to ensure that at least they adhere to those deadlines, and the accurateness of the figures they remit, so that they don't get, for example, failing to file in time, you receive a penalty. And when you delay in making the payments, those deductions that you have not remitted, they earn an interest. And you see now that increases your tax burden, and bloat your expenses as a business. The other bit is on withholding tax. Withholding tax, we have withholding tax mostly on services, for example. We also have withholding VAT. So these ones also ought to be filed as per the regulations, or as per the provisions of the law, so that you don't end up going past the deadline, or maybe you have withheld incorrect amounts. So at the end of the day, you end up getting penalized, for something that you could have avoided. The other bit is for for the landlords, for the businesses or individuals who own properties. Maybe you are a landlord somewhere. The law requires you to file monthly rental income for especially for the residents. For if the how the properties they are not for commercial, for example, you ought to file monthly rental incomes. If you don't do so, of course, there are some implications because, of course, you will be penalized and interest will be charged on the amounts that you have not remitted. The other bit is on income tax returns. Right now, we know we are heading to the deadline of filing our returns. Even as a business, it's important to make prior arrangements. For example, you have to ensure that at least your books of accounts, they are in order. You make proper plans for the audit if you need your audited, so that you file your income tax returns on time and avoid the penalties. The other bit is on e-teams. E-teams is, as we said, currently it's in operation. So businesses at least should ensure that they process invoices through e-teams, so that at the end of the year, they will be able to claim those expenses. And of course, that will reduce their tax burden at the end of the year. Why do we do tax planning? Number one is to ease administration. For example, which are the reports to be prepared? When you make proper plans in advance for tax, you know the reports that you ought to prepare or to keep, the records to keep, and also it makes you aware of the accounting methods that you shall apply. So, for example, will you apply the accrual method or the cash basis method? So, by planning properly for tax, now you are able to be better equipped, or to be in the know on how to handle the different aspects of your business. May it be accounting, how you keep records, etc. The other bit is to improve your cash management and forecast, because tax is an expense to your business. So when you plan for it properly, it means that your cash flows will be efficient, and you will also be able to forecast for the future periods on your cash flow needs. The other bit is to achieve financial goals. When you do proper tax planning, you are able to free up money that you can invest in other ventures. And also, for example, you can save for retirement, and maybe even in other investments that can help you achieve your financial goals. Tax planning also ensures that at least you are able to take advantage of tax incentives. For example, the amnesty program that is ongoing. And I highly encourage businesses and business owners to take advantage of the remaining, I think they are like 3-4 days, to make sure that at least you clear your tax arrears in terms of penalties and interest for periods prior to 2022, so that at least you are on the path of attaining compliance insofar as tax is concerned. There are different tax planning strategies. I will just mention them briefly. Like we have seen in the past slide, in the previous slides, you can itemize the deductions, the deductions that are allowable for your business, and this deductible expenses, when you itemize them, you're able to plan way in advance, so that you are able to ensure that, for example, all your expenses, they should be deductible. And by them being deductible, it means that you need to keep very good records of those expenses that you have incurred. Currently, the law provides that, for example, in 2024 going forward, if this will not be changed later, you need to have generated your invoices through e-teams, so that now the taxman is able to view all your incomes and expenditures online, so that you're not able to claim anything that is outside what you have provided in e-teams. The other bit is to take advantage of the tax credits that we have seen in the previous slides. Maybe your client has withheld 5% of a service of the revenues you received after rendering a service. You should be able to take advantage of those credits while you are doing your returns. Sometimes businesses may operate in the special economic zones, and these special economic zones, they enjoy other additional benefits in terms of tax. So you may want to be aware of the benefit of other additional benefits that accrue to you when you're operating in a special economic zone. And if you don't, like we have said, there are other benefits that you can look out to take advantage of, like the ongoing tax amnesty. I have tackled the issue of timely filing and payment of tax, and this one now ensures that you pay the penalties and interest. The other that goes into this tax planning strategy is your business structure. Maybe you've been operating as a sole proprietor. You may want to think or to figure out which is the most favorable business structure that can help you to reduce your tax liability. Is it a partnership? Is it a company? Is it a proprietor? So you may want to explore those alternatives because different businesses are taxed differently. So, and that maybe you may want to approach a professional, a tax professional, an accountant or financial expert, so you are able to identify the best structure that you should adopt for your business. The other bit is to optimize on employment cost. For example, the medical insurance, we saw it somewhere, the pension contribution and the training cost, these all they are deductible. Before you arrive at the taxable income, you remove these ones from the gross income. So you may want to optimize on these expenses, so that at least you reduce the taxable income. Something that we cannot overemphasize is record keeping for businesses and documentation. Because in case, for example, KRA decides to do an audit to your company or to your business for previous periods, if you have not kept proper records, you will not escape their net. You will not prove otherwise. Because when they do the audit now, the onus is on you. The burden of proof is on you as a business to prove otherwise. So if you don't have proof in terms of the records and documentations, you'll end up paying whatever they insist you have to pay. And that, of course, will eat into your savings, for example, and it will increase your tax burden as an expense. And finally, what is very important is to seek professional tax advice. There are several tax practitioners out here. For example, us, John and Daniel and Partners LLP, we guide businesses on how to handle this tax issue, how to navigate this landscape of tax compliance and regulations. So you may want to seek advice, to seek support, to seek some professional insight in handling this area, so that you stand in a better place, an informed place, so that your business can be sustainable, and at the same time you can be compliant with the prevailing tax laws. So, which is the way forward now? Having seen the tax landscape in Kenya, and maybe how we can plan to remain compliant, and as well as reduce our tax liability, one thing that we should do as businesses is to stay informed. Like whatever is happening right now about the finance bill, you cannot afford not to update yourself on what is happening. You need to know the areas the government is targeting to tax, the implication, your obligation if such laws pass. That is very important for any business and any business owner. Number two is to develop strategies. Having updated yourself on your tax obligations and the probable changes in terms of tax law, you are able now to develop better strategies to align with those regulations, and that helps you to minimize the liabilities and you are able to maximize the benefits. Also leveraging incentives, like we have seen, you get a competitive edge when you are able and you are able to identify and take advantage of the available incentives and credits. That means that you reduce your tax burden. And by doing all these, you are able to optimize compliance. When you file your returns on time, when you pay the payment, you remit the payments on time, you avoid penalties and interest. So you are able, for example, to when an organization is maybe applying for a tender or expressing interest in some consultancy work, and you are asked to provide your tax compliance certificate, if you are compliant, that is one thing that you can acquire at a go. So you're able to optimize compliance by proper tax planning. And finally, tax issues need to be handled by an expert. They need to be well discussed with an expert, so that you get assistance on how, for example, you can optimize your tax planning measures that you have in your business, and at the same time, you ensure that your business is compliant with the prevailing tax regulations. So that was the content that we had prepared in this in regard of this area. And at this moment, I would invite Frida maybe to take us from there. If we have questions, we can answer them. If we have comments, we are keen to hear them or to read them. Frida, could you please take over?
Thank you so much, John, for that wonderful presentation. And now welcome to the question and answer session. On the chat box, I can only see one question from AM. Is asking on installment tax for a new sole proprietor business for services that started this year. What is the installment tax calculation since there is no previous year net income? And then the second question is, what is the penalty for not paying installment tax?
Thank you, Frida. So for new businesses, you may not be able to know, to project your income, or the tax that you will pay in the following year. So mostly these new businesses, they won't be obligated to do the installment tax because you have not calculated any tax in the past. So it will only happen after you have filed for 1 year, so that now you are able to project based on what you got last year. You are able now to project for the following year. Yeah. I hope I have answered that question effectively. Frida?
Thank you, John. I can't see any other question on the chat section. If you have a question, please, you can raise it in the chat box or raise your hand, and then John will be able to address it. In the meantime,
Okay,
John,
okay.
maybe.
Sorry, I think I saw another question just below that question. Sorry, I had missed it out. Someone, the same person was asking if what is the penalty for not paying installment tax? It is 20%. The status quo right now is 20% of the difference between the amount of the installment tax payable in respect of that year of income, and the installment tax that you actually paid or you have paid. So the difference, it is charged 20%. So, and you can remember in our slides, the proposal this year was to reduce that to 5%.
Maybe I can
Rita?
Can make a comment also.
Okay, yes, Dan, please.
Thank you, John.
Sorry, you are not audible.
Thank you, John. I hope I'm audible now. For the good presentation. Just to make some clarification a bit on the installment for a new person. Not a new person, but the first year, the first financial year for taxpayer. What is used is the estimate, is the estimated income for that year. And remember, in installment tax, depending on the kind of business you are in, let's assume, for example, a consultancy business where all your invoices are being withheld by your clients. It is like automatically you're also paying installment. So you also have to consider the taxes that have been withheld. But for the first year, because the law provides for the estimation, it's actually the higher of the 10% for the previous year, and the estimated income. If, for example, your performance last year was 1 million profit, then based on the 10% as John presented, then it means you'll be expected to grow by 100,000. That means the subsequent year's profit to be 1,100,000, 1.1 million. But if it is higher, for example, it can even jump, say, to 5 million the second year, then you should pay on the 5 million. The estimated, and I'm using estimated because, of course, as a business, you'll be able to estimate. And remember, you're also doing it on quarterly basis. Therefore, the first quarter, you'll be able to tell. Based on the way you are progressing, you can be able to say, maybe in the second quarter, you'll be able to adjust and such things. Having said that, it's also good I mentioned that taxes, it's usually very difficult to give tax advice generally in a webinar like this, because tax is usually very specific. It's a law, and laws have details. They have details. They'll give provisions. Unless, and so many specific issues, which can only be considered in a fair way when we are looking at a specific entity. So I really encourage that seeking professional advice, as John mentioned, is very important. So don't rely on the press generally, where you have read in a newspaper or in a post in social media. There will be specific issues that may be targeted at your kind of business or may apply to your kind of business. So you have to be very careful so that you don't generalize. Also, another comment, if you allow me, about the finance bill. We know what has been happening. We are aware that the finance bill, the president referred back the finance bill to Parliament. I've seen in social media, I don't know whether it's true, but he was basically directing Parliament to withdraw the provisions. If that is true, then it also means there'll be some things which can be lost in so the good things that I think John highlighted a number of them. But we need to be very careful when we are discussing the finance bill, because the finance bill is something that comes every year, and it has been coming every year for as long as I can remember. But because of the awareness and the kind of the political environment that we are in, if you look at this year and even last year, the discussions and the debate of the finance bill was very, very publicized. And it's very easy to lose what is this finance bill, because generally the media will present like it's just a bill to increase taxes. The finance bill targets to amend several laws, which is at a go. If you are to get a copy of it the way it reads, the legal jargon that it contains, it will talk of, for example, amending the Income Tax Act. So it's a bill to amend many other pieces of legislation, many other acts of Parliament. So it will amend, say, VAT Act, it will amend Income Tax Act, but it will also go ahead and amend other acts, which may not necessarily be directly related to tax, but basically are in line with what the government wants, in terms of policy, budget policy. Let me give you an example. If you listen to the budget when the CS was presenting, and it was captured also in the media, the capital, minimum capital for banks was proposed to be increased to 10 billion. the capital for commercial banks in Kenya. And he said he'll present it to the industry to come up with a program on how to actualize the 10 million capital requirement for commercial banks. If you look at it, it has nothing to do with the taxes, but you see it's amending the Banking Act, and it becomes a provision in the finance bill. There are so many others that can be, it can amend even Insurance Act, depending on what the government would want. Now, alternatively, let's assume it has been withdrawn as a whole, the finance bill. The government can still present to Parliament amendments to specific acts, not necessarily through the finance bill. So it can still happen. So we need to be going beyond what is generally presented in the media, because media usually captures generally what the public would want to hear, what generally the public is discussing. So it may cover up, those discussions may cover up what the specific issues which are important to your business and which may be more touching to your life, as a business person or as somebody who is involved in a business. So it's always good to go beyond what is being captured in the media generally. Thank you. That's a comment I wanted to make.
Thank you so much, Dan. I can see we have more questions. There is one from Patricia. Thank you for your educative session. Kindly repeat for us the tax changes in the retirement benefits and housing relief, and if there was any changes on the life policies for the insurance companies. John, please.
Thank you, Frida. Thank you, Patricia, for the question. So from the proposed changes, the retirement benefits and housing relief was to be scrapped, but instead now these deductions were to be allowable deductions before you arrive at the income that will be chargeable to tax. So that is the difference. Currently, I think we just enjoy the relief for example, for the housing levy and the retirement. But for retirement, as it is right now, you understand that NSSF is as it is the only deductible before you get the taxable income. For the insurance policies, no changes. Besides now the withdrawable amount that we have covered in the slides.
Thank you, John. Patricia, hope your question is addressed. And then we have another question from AM. Is asking for a clarification on the installment tax, if it is a consultancy serving retail customers with payments being less than 5,000 per customer, so below the withholding tax threshold, revenue positive but loss making. Sorry. AM, please. Or John, you got the question. You can unmute maybe and raise your question.
Frida, I think it's not clear to me. Maybe AM can clarify the question.
He's asking what is the installment tax obligation for loss-making, I think, companies.
Okay. I think I get him. So, like Dan mentioned, both the new businesses, and even the loss-making business. You see, you can make a loss last year, but this year you project to make a profit. So for loss-making and the new businesses, they're obligated to estimate their income for that year, so that they are able now to know the tax they should pay in the 4 quarters.
Thank you, John. The other question was still from AM. He was asking for a business hiring a student intern for 1 month only, one time. What taxes should the business or student pay? Assume the intern's stipend payment is 10,000 shillings. Hello, John.
Yes, I can hear you, Frida. Now, we know, we understand that for the worker to be subject to the statutory deductions, their income must be above the threshold of the minimum wage, which is now it's 24,000. So I don't think the 10,000 will be subject to any statutory deductions. So it's for the business. It's for the business now to decide maybe how they will treat that. But currently, it's good to declare these payments in the payroll as you file it. Even if you will not pay any statutory deductions, it's good to declare them as you submit your payroll returns, so that at the end of the year, you're able to claim this expense as a business.
Thank you so much, John. Okay. There's still another question. He's asking, what do you mean by payroll filing?
I mean by, you see, every month you file the payroll statutory deductions. That is pay, NHIF, NSSF. You file them by 9th of the following month. And that's where you declare the amounts that you are remitting for those employees. Yes, that's the meaning of the payroll filings.
Okay. Thank you, John. There being no any other question, maybe I will allow you to give your parting shot. Or still, what is the minimum wage for housing levy deductions?
Rita, thank you for the question. I think currently we don't have the minimum for payment of the housing levy.
Thank you, John. As we wait to see if there are more questions, maybe you can give us your parting shot.
Mine is to appreciate all the attendees of today's webinar. Our aim has always been to empower businesses and business owners with insights that will help their businesses to thrive and to remain sustainable, and also to update them on for example, the tax trends, the new developments, for example, in tax that may affect their businesses. And it is always our pleasure to add that value to the businesses and business owners. And like I highlighted, businesses right now, they're operating in a very fluid, in a very volatile landscape in terms of taxes. So my parting shot would be for the businesses to remain updated on the tax developments, on the regulatory changes, so that every time they are compliant, to avoid, for example, penalties and any other adversities that may come from not being compliant. I thank you all.
Thank you so much, John. At this juncture, I'd like to appreciate everyone for tuning in and listening to our webinar. That marks the end of our webinar. And before we close, I'd like to encourage each and every one of us to always seek professional assistance. We are here to guide you. We are a CPA firm based in Nairobi. We are John Daniel and Partners LLP. Allow me to make a quick presentation of our firm. So welcome to John Daniel and Partners LLP. As stated earlier, we are certified public accountants based in Nairobi, Kilimani. We believe in teamwork, integrity, and excellence. We are here to empower you to run your business. As you focus on other affairs of your business, we help you with your professional needs on matters accounting, bookkeeping, taxation, management advisory, both internal and external audits. Our team is multi-talented, all-rounded, with both local and international training. They are CPA finalists, and we are zero certified advisors, passionate about business and consulting. Our key practitioners are CPA Dan Chege and CPA John Guri. These are some of the clients that we have previously worked with or served. They range from the real estate, the government, manufacturing industries, and governmental organizations, and even schools. Our key partners are Xero. It's a cloud-based accounting software. We have also partnered with WorkPay for payroll management, and UpeoSoft, which is an ERP next software. Our business approach, we first seek to understand the needs of our clients. We contract, we plan and deliver, we discuss and consult with you, and then we conclude and develop the relationship with our clients. So we seek to build a long-lasting relationship with our clients that is based on trust as we serve you and empower you, and you focus on the affairs of your business. So thank you very much for your time. We normally have these webinars every other month. So I will share the recordings for today's meeting and encourage you to watch out for our next webinar at the end of July. Thank you so much for your time.
This is brought to you by John Daniel and Partners, LLP.